Hello, my friends. Brett Pattison coming at you from the financial capital of the West, along with the chairman, Brian Hunsaker.
Hello, Brett.
Hey! What a gloomy time it's been in the market, Brian.
It looks really nice outside, though.
It's a beautiful day outside. In fact, let's talk about that for a second.
Yeah.
So my boy Tommy plays football, baseball. My other boys played lacrosse. And here's what happens. Okay? Yesterday, for example.
I'm glad that Tommy's playing football.
Oh, man. You ain't kidding, brother.
It's a great sport.
So here's what happened. He had a game on the road yesterday. I pull up the weather app, and it tells me 65 and rainy. Okay. Well, 65 and rainy, how would you dress?
Probably take a rain jacket, probably long sleeve, maybe a hoodie, yeah.
Dress a little warm.
65's
65's
not
pretty
that,
comfortable.
Not that cold, yeah.
But 65 and rainy. So I get to the game up north, and man, beautiful. 85 degrees, sunny, completely different than what the weatherman said.
They got it wrong.
So what I've learned to do, Brian, is I've got this big bucket in the back of my truck, and it has raincoats, and it has umbrellas, and it has blankets, and I always dress light and then put that on because I know they're going to be wrong.
Mm-hmm.
Nothing against weathermen, but I know at some point they're going to be wrong.
Yeah.
So you got to prepare. So here's a quote for you. That's what we're going to talk about today.
All right.
Forecasting. Hey, here's a quote, and I'm going to be referencing a great memo by someone who we love, Howard Marks.
Mm-hmm.
We'll both be referencing that. Because what's happening in the market? What's going to happen? Well, what's our prediction? Well, let's talk about it.
There's a lot of predictions right now, a lot of forecasting, a lot of predictions. I'm not sure I've ever been through a period like this where there's been more than what we're seeing today. It's an amazing amount of forecasting, predicting, and it's mostly doom and gloom.
Yes. So there are two kinds of forecasters, said John Kenneth Galbraith. Those who don't know, and those who don't know, they don't know. So back in, was it last year, the Fed, what did Jay Powell say about the market?
Speaking of forecasters.
Because the Fed should be the most important forecaster around. Needs to be.
You would think. So at the Federal Reserve, there's 400 PhD economists that work for Jerome Powell.
That's a lot of smart people.
A lot of smart people.
Yep.
And this is the conclusion they had in January 2021, less than 2 years ago, just a year and 9 months ago. Frankly, we welcome higher inflation, declared Federal Reserve Jerome Powell in January 2021. The kind of troubling inflation people like me grew up with seems unlikely in the domestic and global context we've been in for some time. And that's what his staff told him back in January 2020. And that's what he told.
We welcome higher inflation.
Yeah, we welcome high because we're not going to see the kind of inflation that we saw back in the 70s and 80s, which I remember. I was in high school. You wouldn't remember this, but I remember high inflation in the 70s and 80s. So it's been a while since we've had this kind of inflation.
You know what that quote is? That's the weatherman saying it's 85 degrees and sunny, and me showing up to a football game, and it being 65 and rainy.
Yeah, exactly. And not prepared.
Exact opposite.
Yeah.
So I got a question for you. A lot of stuff is happening in the market right now. I had to actually turn off CNBC. I can't watch it because everybody is bearish. Like all the sentiment is bearish, and people predicting 2,200, 2,600 on the S&P. Like global chaos and failure of governments and I mean all sorts of crap going on. Here's my question to you, okay? And this is the question Howard Marks has in his memo. He says, here's a series of questions for you, Brian, and I want you to answer them. Okay? What's your expectation regarding inflation over the next year? Will there be a recession? And if so, how bad will it be? How and when will the Ukraine war end? What do you think is going to happen in Taiwan? with China and Taiwan.
Okay.
And what's likely to happen in the 22 and 24 elections, and what's their impact on the markets?
Okay.
How would you answer all that?
Well, I can go through each one of those, and guess what? I do have opinions. I have an opinion on every one of these. I think all of us have opinions on various subjects and topics, and there's nothing wrong with having an opinion.
Mm-hmm.
But
we had an opinion on a podcast earlier this year. I believe we're in a recession. You don't know, or said, nah, not yet until I see some other stuff happening.
well, basically the way I felt was I just don't know. And
those are opinions.
And I did say that I would be surprised that we are in a recession. So I had an opinion. My opinion was I don't think we're in a recession, but
yeah.
But I don't know. So there's nothing wrong with having an opinion.
Yeah, opinions are fine.
Opinions are fine.
So what's the difference then?
But each one of those questions that you asked,
yeah,
I have low confidence in my opinion on each one of those, even though I have an opinion on how the election turns out, inflation, how that I do believe in regards to inflation that we will get it under control. I have hope that we're starting to see the effects of that.
Yeah.
That inflation is peaking, but I don't have incredible high confidence in that. And so because of that, we're not making big investment decisions based on these low probability predictions or forecasts or opinions.
That's the key right there.
What I do have high confidence in, and I think history would support this, is that over time we will get through these some of these questions or problems, potential problems in our economy. We will get through these, and businesses will survive. Businesses will come out on the other end of this looking pretty good and actually be good assets to be invested in over the next 3, 5, and 10 years. What happens over the next 6 months, 3 months is anybody's guess. But we believe, I always think about it in these terms. If I could say with high confidence, high probability that, say, the S&P would double over the next 10 or 15 years, does it really matter what it does between now and then? I mean, if you knew the S&P was going to be at around 8,000 in, say, 10 or 15 years, between 10 and 15 years, does it really matter where it's
in the next 6 months?
In the next 6 months,
yeah.
It may, if you are actually living off of your investments and so we have different strategies for
smart
those.
Planning,
right? Yeah. We have smart planning for those people living off their investments. But if your goal is to build wealth over the next 10 or 15 years, then what happens tomorrow, the next day, the next 6 months in the market shouldn't matter.
So we're gonna talk about our secret recipe for forecasting, because we do have a high probability that something's going to happen. We're going to mention that here in a second. But here's the problem. When I asked how will the Ukraine war end, we might have an opinion on that.
Sure. In
fact, we were you and I have been talking about this for a while, and we're familiar, although I will not mention names or firms or anything like that. We're familiar with a local firm that made a kind of a big bet on something, and put a lot of client money in it, and it completely failed. And these poor clients are now out of a lot of money, or now have to make up a lot of money because of that loss.
Yeah.
That's where people get into mistakes. Why do people forecast anyway? Like, why do firms, JP, Bank of America, why do firms like ours even forecast and have such strong opinions about what's going to happen? Why do they do it?
Well, I think it's just human nature. Everybody has an opinion, and it's human nature to express your opinions. And I know there's a lot of people. I mean, I talk to people, even clients sometimes are pretty confident that about the economy or the election.
Yeah.
And I don't know where they get their confidence level, about things, because these things are really hard to predict.
One of the biggest firms in the country, and I don't want to say the name, but everybody would know it because they run commercials all the time on TV. Every year they come out with a prediction, a forecast. We're going to be up big this year. We're going to be up a little. We're going to be down a little, or we're going to be down big.
Mm-hmm.
That's their four, I don't know, stages of their forecasting. Okay, I talked to a client who has a little bit of money with this other firm, and he said they came out and said they're going to be up a little bit this year. Now they're coming out, and guess what they're doing?
Changing it.
They're changing their forecast.
Yeah.
We're going to be down a little bit this year. Like, why even make the forecast in the first place?
Right. It's funny. Yeah, exactly. Why do they make
and
the forecast?
By the way, very smart people. Not 400 maybe, I don't know, 400 PhDs. It's crazy.
It's crazy, and unfortunately, in fact, Howard Marks talks about this. People who make predictions, stock market predictions, economic predictions, you very rarely, if ever, see a track record on their predictions. No one, show me your track record on every prediction you've made. How many of them came true? What percentage of the time are you accurate? And I would suggest the reason we don't see that is because nobody publishes it, because it's terrible.
Yeah.
Nobody can predict. In fact, I know you're going to talk. You can talk about Nick Murray here. He just wrote a recent newsletter, and I love the title. It says "Nobody Knows Nothing," and it's so true.
Yeah.
And he talks about several examples about how economic forecasts, stock market predictions, have been so wrong. He talks about several examples.
So here's the thing, and I'll end the forecasting with this quote from Warren Buffett. Forecasts usually tell us more of the forecaster than of the future. Right. So, but Brian, we at Irongate, we position portfolios in a way to create wealth long term for our clients, and we take advantage of short-term volatilities, sell covered calls or sell puts or whatever it may be, to generate more income for our clients to then buy stocks that will compound over time. We're taking a stance, right? So somebody listening to this will be, well, then why do you invest the way we invest? So we're taking a position for our clients in how we build portfolios, buying the best businesses in the world at prices that are good. We've talked about that.
Right.
Why do we do that? And that goes to the history.
Right. Yeah, we want businesses that can compound wealth over time, and that have the ability and have shown the ability. The strength of their business is so strong that they can get through tough times. They can get through tough economic times and recessions, and that's how we invest. We are investing with in mind that yes, we will go through hard times, and we have. And
we are right now.
We are right now. I've been doing this 30 years. I've been through several recessions. I went through the Great Recession. I went through the dot-com bubble burst, the bubble and burst. All of us through the coronavirus. We've been through tough times, but I do know, and I feel confident. Maybe this is a prediction. In some ways, I am predicting. I'm predicting that our businesses will do well over time. I'm not predicting the stock price tomorrow or the stock price in 3 months, but I am predicting that over the next 3, 5, and 10 years that our businesses will do well, and we'll be happy that we own these businesses.
And when we say our businesses are doing well, we're talking about earnings, the future earnings that they're going to generate.
That's what creates value. The reason stock prices go up is because their profitability goes up. That makes them more valuable. If you have an asset, you have two assets. One asset earns $1,000 a year, and the other asset earns $2,000 a year. Which one would you rather own? Which one's more valuable? It's the one that earns more. So it's pretty straightforward.
So tell me this. I look back in history, as Howard Marks mentions, and as we've talked about a lot, using history as our guide. I can think of 1970 through 80, high inflation, like gloom, that period of time. Tell me what the earnings of the S&P 500, tell me where they were in 1970 compared to 1980. I would love to know.
Okay. So in 1970, the S&P 500 earned $5.51 per share for each share of the S&P 500.
Okay.
$5.51.
$5.51.
So, is that right? Yeah, 551. In 1980, this was a tough time. 70 to 80, high inflation. Some would argue it's very similar to the environment we're in right now.
74, I think, is a pretty close match to where we are right now.
So here we are, 1980. Earnings were nearly $15, $14.99.
No.
Yeah, tripled.
So it went from where to where?
So the S&P went from $5.51 to $15, almost triple, not quite triple.
Okay.
Tripled earnings over that time. So really, in essence, valuations increased about 3 times, approximately. There's other factors that go into valuation, interest rates and inflation, things like that. But the S&P 500 price. So what would you think the S&P 500 did over that time frame? Everybody talks about the 70s as being a really terrible time.
I would guess it did about the same.
It was a really terrible time. Well, the S&P price in 1970 was 92, and in 1980 it was 135. So it wasn't a great. It
didn't catch up to earnings.
No, earnings were up significantly. Now the S&P 500 price was up 50% or so over that time frame, maybe a little less than that.
And that would still shock people.
But and the reason why S&P prices didn't go up as much as the earnings is because we had inflation and higher interest rates. Yeah. That was why.
That ate into the returns.
But you did make money. Long-term investors made money during that really difficult time.
14% inflation around there.
Right.
Yeah. Insane.
Inflation and it peaked in 1982.
Yep.
So
what is that, though? I mean, we're talking about earnings. What was it in 1960 compared to this year?
So
what's the increase?
Here goes from 1960, the S&P. I have data going back to 1960 through 2021. Of course, I have the forecast for this year on S&P 500 earnings. In 1960, the S&P 500 earned $3.10. $3.10.
Okay.
Here we are in 2022. In 2021, we earned $206 a share, and in 2022, the forecast, at least the latest forecast,
which may come down,
was 226.
Okay.
So the average annual S&P 500 growth over that time frame was 7.2%. Your money, and we've talked about this, the rule of 72. The rule of 72. If you can earn 7% on your investments, or you compound your money, your investments at 7% a year, your money will double every 10 years. 7 into 72 is 10. So every 10 years, your money will double. And that's basically what happened. Is every 10 years, the S&P 500 earnings doubled over time. The price, guess what the price? The price in 1960 on the S&P 500 was $58.11. And just today, I just updated this just a few minutes ago. The S&P 500 was 3,847.
And what's happened since 1960 to today?
So guess what the average annual return is on the S&P 500 price?
It's the same.
It's 7%.
Yep.
Almost identical to the S&P 500 earnings growth. And there's a reason for that. The reason why stock prices go up is because profitability goes up. And they almost over the long term, stock prices follow stock earnings and profits over the long term, almost lock in step.
So we're going to be forecasters. Okay? So now I've bashed forecasters.
Okay.
Now we're going to forecast.
Okay.
We're forecasting that America's best days are ahead of it, that we will become more innovative. Companies will adjust and pivot as they need to. The ingenuity of the people in this country will continue to increase, and that again, America's best days are ahead. And because of that, those earnings on the S&P will do what they've always done in history, and there'll be periods of pure hell that we're going through right now. But you know what? We're betting on America.
So let me just point out. I 100% agree, Brett. But let me just point out in 2000, the financial crisis, right?
Yeah.
S&P 500 earnings. The financial crisis in 2008, the S&P 500 earned, well, 2007, $82. In 2008, they went down to 49. But then just a couple years later, in 2011, the S&P 500 earnings was 96. So yes, we have stops and starts and downturns and recessions. And by the way, that was the worst recession since the Great Depression. And yes, it took a couple of years for S&P 500 earnings to get back on track and grow, but it will. And I'm confident in that, and I 100% agree that. And I've heard Buffett talk about this all the time. America's best days are still ahead. I look at the technology that we see today around the world, and all kinds of exciting technologies, and I am optimistic about the future. Are there things that I worry about? Absolutely, there's things I worry about. I am worried about inflation. I am worried about higher interest rates. I am worried about a potential recession. But we will get through these, and I feel very good about the companies we own, that they will do very well. They'll do very well over the long term, and they'll be able to get through these troubling times, and that we'll come out of the end of this, whether that's 6 months from now or whatever, we'll come out looking
better than ever.
Better than ever, yeah.
And we'll be making new highs. The best thing about a bear market is there's a new bull market right around the corner.
Yeah.
Right? So here's something that I'll leave us with from someone, again, Nick Murray, who we love. It's a quote from a Barry Bannister. He says, "The stock market," and I want everyone at home to listen and to think about how this applies to you. "The stock market will find your own weakest personal trait and then do everything in its power to use it against you." That's the emotions of the stock market, of having your asset priced every day on a ticker screen, is it creates psychologically fear and causes you to want to do things that you shouldn't do. We're saying our forecast, bet on the country, we'll get through this. Bet on lower inflation in the future. When? I don't know, but it'll happen. And earnings will continue to increase for these amazing businesses that we own.
Yep, I agree.
That's the bottom line. So guess what we just became?
Forecasters.
I started out bashing forecasters. Now we're forecasters.
Yeah. Don't bet against America. We are the best house on the street. I mean, there's not another country in the world I'd rather live in than the U.S. for sure. We have the best businesses in the world. We have rule of law. I mean, we have our problems, no question.
Yep.
But Europe is struggling. Asia is struggling. I mean, Latin America, we are by far the best game in town, and we should feel fortunate to live here and own these, be invested in these great businesses.
Yep. And our wealth and the future wealth of our clients is based on what we just talked about with earnings in this country. So, with that, my friends, turn off the news and enjoy a great weekend or week whenever you listen to this. Until next time, bye now.